welcome. Hope everyone's doing well. 2 videos in a row now. I said I would look into HPK, so that's how we're going to start this video here. I'm just going to crack straight into it really. I've already got some of it loaded up, ready to go, although I've not got it in here yet, so let's start by doing this. HighPeak Energy, independent oil and natural gas company. Fort Worth, Texas, by the look of it. So it just came up on my screen a while back, and I've got a funny feeling I had a very brief look at it. I thought, oh, might be something worth investigating in that, and then I never did it. And then I realised when I was editing the video to put up that I said I'd do it, and I hadn't. So that's what we're going to do now. We're just going to start this video with that, and see what we come up with. Currently $5.57 a share. Oh, gross margin's fallen off a bit of a cliff mine there. Look. Revenues have declined. Book value more than double what it is now though. Interest coverage is very low. That's not nice. Don't really like to see it that low. $7 in revenue a share, so it's trading less than one-time sales. Alright, let's have a look, because there were some things obviously that the screener liked, so, and to be honest I can't remember what I said on that video. I recorded it a couple of weeks ago I think, so we'll crack into it and see what we can find. It is, so HighPeak Energy is a US oil and gas exploration company focused mainly on the Permian Basin in Texas. So what I will do as I am going is I will start filling out my tracker where I put notes in, who owns it, insiders, the business model, revenues, how they're broken down, geographically, segmentally, depending on the business, what the risks are to it, if there's say what's been done to combat the decline, because most of the stuff that my screen is picking up is dog shit. Talk about the balance sheet, the income statement, cash flow statement, and then any like discounted cash flows or multiple analysis that I've done would go into this bit here. I always have the balance sheet at the top of all the statements because to me it's the most important one. You need to know that the business is fundamentally sound more than anything else. Bloody tracker just reloaded. I've got to wait for it to catch up so I can get back down to where we were. Right. Doing this off screen by the way, so there we go. HPK. Insiders purchased quite a bit, but a long time ago, end of 2024, but that's a significant amount by the CEO, Jack Hightower. Now, the other thing I noticed is that 100% of his US portfolio is in HighPeak Energy, so, you know, that's what you like to see, really. You want to know that the CEO, the business, the board, anybody like that is got skin in the game, so just take a quick screenshot of this and then I dump this into my tracker. And then let's stay, what should we say? Problem is all this is happening off screen, so to you nothing's happening. You just have to listen to my dulcet tones. No one's really, who's this? DeJoria, Paul John DeJoria. Based out of Austin, Texas. Okay, so he is holding other things. Nowhere near as highly valued as this, but whoever he is, let's Google him and see. American businessman, his American billionaire businessman, co-founder of the Paul Mitchell line of hair products. He? Well, he's gone into oil. It doesn't seem to line up, does it? Why would someone who knows hair products go heavily into oil? I mean, it's probably not many. Paul, what's his name? Paul John DeJoria. There's probably not many of them, but 85% of his stuff in an oil field. Can I see anything here about oil? Speak. Tropic work. Is that even the right guy though? He's Paul John DeJoria, or is he? I don't know. It could be John Paul. Well, what else is he holding? Pharmaceuticals. IT. Based out of Austin. Where's this guy based? Does it say? He's going to be in Texas, because Ted Cruz is Texas. Okay, well, just seems a bit strange that a hair product guy's gone heavily into oil, but we'll see. See what the rest of it brings up. Publicly traded for a SPAC, reverse merger, special purpose acquisition company rather than a traditional IPO. Right. Business model. What can we write for that then? Oil and gas exploration. Oil, gas exploration in the Permian Basin, Texas. Not that you can see this, but I am reading out directly everything that I've wrote. I tell you what, when I used to ask this question up here, explain HPK, HighPeak Energy, a few weeks ago, maybe I've just not used it enough and it's unlearned what I'm looking for. Maybe, I don't know if it works like that. It would come out and give me everything, like a breakdown of revenues and everything. And now, for the last couple videos, it's given me something completely different to what I'm asking for. Not completely different, right? Because obviously there is some sort of synergy with it, but not what I'm after. And it seems to either forgotten what I'm after, or ChatGPT is not having a strong point. So I had to say, no, the company floated on the stock market, you fuck nugget, because it wasn't giving it. And now though, it doesn't do. They could just not have remembered how I used to ask questions. I don't know, but it seems to have changed recently, and it's not a good change. So what do I want to know? Explain how the business operates. Revenue breakdowns and segmental breakdowns. Let's see, maybe we can try and reteach it. US-based independent energy focus on exploration, crude oil, natural gas, and for gas liquids. Identify new drilling wells, extract oil, gas, land management, maintaining, optimizing over 140,000 net acres. Asset optimization, enhancing well performance and reservoir recovery. Single segment operational model, doesn't have separate business units like chemicals. Okay, revenues. So 78% plus the total sales volume comes from crude oil. They got that on here. Statement of operations, crude oil, yeah. This is all the costs, so income from operations, net income 44 million. What's the market cap on this? What is the market cap? 700 million. An EV of 560. Let's write this in here. 700 million EV. What was it? 560. So already there's more cash than there is debt. Where's the balance sheet here? 164. That can't be true, can it? 164 million, because there's. This is why my data is wrong. Because I'm pretty sure there is not zero debt. So the EV is way higher. All right, let's just check that. This is why you do have to be on top of the data. Majority of the time, it's reasonably trustworthy. Other times, there you go. Zero debt when you're missing 1.62 billion. 1,162,300. Put it in here. 1,162,300. 1, 2, 3. Boom. Is it down here as well? Total debt? No, it ain't. So that needs to plus. Hang on. Equals 1,162,300. 1, 2, 3. There. Now, our enterprise value is wildly different. 1.1 billion higher. 1.7 billion. I'm just writing in the tracker. Okay. Right. Back to where we were. Now the data has been adjusted. Do they break down their revenues? They must do, I would imagine. You know what? Oh, pardon me. I've always I like looking at that quick view. I've always found that if you want to get into the weeds of it, you need to open the main 10Q, 10K, acquisition, divestitures, pension, well costs, organization, nature of business. Asset retirement obligations. Did he break it down or not? Possibly not. Okay, crude oil sales. There we go. Yeah, hugely. It's higher than that, and it's higher than 80%. Oh, what am I going to write there? Almost all revenues come from crude oil. At least recently, in recent years. Almost all revs from the crude segment, with a very minor amount coming from natural gas. Right. 2024 revenue, so it's out of date. I generally find that it is on AI. It's not most up to date, but 2012 months revenues declined roughly 880 million. What have I got? Around about that in it, 880 million, yeah, okay. So it can be right, even though I was just slagging it off. Crude oil, natural gas production. Exploration abandonments. Okay. I take it they're going to be benchmarked on WTI then, aren't they, in Texas? Main revenue source, segment report, and all revenues classified under E&P. is the benchmark WTI or Brent? Just so we know for WTI, yeah, I thought it would be. WTI is the benchmark. That's just so if I come to do any forecasting, I know which oil price I am forecasting against. I should have them both in here. That's WTI, I think, and that one's Brent. Yeah, they are two different prices. That's correct then. What's going on there? So bloody Brent's gone up, even though when I did my PTAL analysis, PetroTal, which is in Peru, forecast was that Brent was going to be about $55 this year. Yeah, both WTI and Brent both bottom, double bottom. Technical analysis here, double bottom around the same place and rejected that area quite nicely. Interesting. To fundamental analysis. So 9 months ended. Jesus, the earnings have dropped massively. Almost half. Almost a 50% drop. Simple free cash flow as well. Margin is always negative. That's a 3-year average for mine. That's why they went for a very shite period here. Return on capital is terrible as well. I used Joel Greenblatts' return on capital from, I think it's a little book that beats the market. Found it's very similar to what Lee Lu used for return on capital as well. When you watch his Bruce Greenwald lecture, so I thought it would be a good one to go along with, and on the equity of the business, not on like market cap or anything like that. I've got a breakdown here. Look. EBIT divided by tangible capital employed. Tangible capital employed is net working capital plus net fixed assets. Net fixed asset equals depreciated net cost of fixed assets. Yeah. Okay, so down here, look. EBIT declined significantly. Simple free cash flow declined significantly. So basically, revenues, earnings, free cash flow, revs, earnings, and free cash flow have all declined significantly. Why? Has it got anything on? Up here. HPK is on my screener. If I typed in HPK here, it is on the screener. See, it's just further down the list. So I obviously had the list set up to view in a different way previously. No news. Let's have a look. On track for lowest close since October 20. Nothing this year. Look. No news this year. Already up 25% as well since 30% in a month. Interesting. Net loss driven by lower prices, reduced volume, and debt extinguishment. Liquidity remains strong. So let's have a look then. Debt extinguishment, but debt's gone up. Let's have a look in the actual balance sheet. Like I said, you've got to take it with a pinch of salt sometimes. Total debt, yeah, it has gone up. Earnings. So what did they pay off down in the financing section? Borrowed a term loan credit facility. Repaid 30 million. Repayments on the term loan 90 million. It's the latest year here, 2025. 9 months, 2025. Net cash provided in financing activities 86 plus 86.5 million. Right, here we go. The WTI fell from 2022 highs of 100 plus. This one here. I mean, 2022 is a long time ago. I may have just unprofessionally yawning green. 2023-25 price is meaningfully lower, more volatile, high liquid exposure. Revenues moves almost directly with WTI, even if production stays flat. 10 to 15 materially compressed revenue and margins. Yeah, I understand that. Drilling and completion inflation, service costs, and let's have a look then. Has the cost gone up? So I've got these sort of metrics here. Look. Operating margins dropped, SG&A margins gone down supposedly. Obviously gross margins dropped as well, so the costs have definitely changed. Cost of revenue. I would guess comparatively, especially when you look back here at 500 million, comparatively you've lost close to 250 million in revenues, and your cost of revenues only dropped by 100 million, so gross profits severely impacted. Heavy capital spending, aggressive new drilling programs, bringing on new wells, expanding infrastructure. CapEx has been high. Alright, let's have a look. Oh, we're on it already. Idiot. I mean, it ain't no different to last year. I mean, I don't know what's going on with ChatGPT. But like the large portion of my using of AI to help me, it's been really good, but it seems like it's not right with it at the moment. Natural gas weakness. I get, yeah. Got nat gas on here as well, I think. There you go. I mean, I suppose it has dropped significantly. It's such a small portion of their earnings when you look at it. $12 million out of the 600, you know, it's not. Shouldn't materially impact the business, should it? Why free cash flow drops even faster than over. Might have to move over to Grok if this declines are primarily due to lower WTI prices, margin compression from cost inflation, high growth CapEx, weaker gas prices, financial leverage. What do they spend on? Interest expense, 110 million. Big, in it. Income from operations, 166. 110's gone on interest expense. What's their long-term debt schedule? Who owns the debt? Term credit facility. I tell you what though, AI is really good for, right, is dumping all this in. So here you go. Can I do this? Can I do the whole lot? Dump it all in. And then just say, break this down for me. Plain English. 1.192 long-term debt, 1.162 revolver drawn 0 versus last year. So debt's gone up We knew that anyway, didn't we? Because I'm sure it said it took on 180 million more. Where was that? We're just looking at it, weren't we, in the cash flow statement? There you go, 108 million more. Core of the capital structure, 1.2 billion outstanding, maturity September 2028. It's only 2 years away. That's a bit of a bugger, isn't it? Because there's not enough. 164 million. And free cash flow currently 39 million. Are they going to pay off that 1.2 billion? 160 cash and 40 million in free cash flow? No. It's very expensive debt. Default occurs 2% plus penalty interest. Bloody hell. Not that you potentially think they're going to default, but to be honest, probably looked at enough of this already. About half an hour in, mine should have said no a lot faster than this. Got to get into the Monish Probright no mindset. I'll have to write down a list of I have got a checklist of what to look for, but I'll have to write down like a checklist of, have you seen these things right off the bat? No, fuck it off, find something else. Happened in August 2025, extended maturity 2028. Oh, so they've extended it already, amended the loan. Upsized borrowings to 1.2 billion, deferred 30 million for 1 year. $25.4 million loss on extinguishment directly hurt earnings. So, can we see that? What was it? 25.4 million. Months ended. There it is there. Gain and loss of derivative, loss on extinguishment of debt. I mean, I suppose that's significant, isn't it? If you didn't have that, it would be materially higher. So I suppose that's a one-off event. I'm assuming it's a one-off event. I assume, by the way, we're actually going to invest in it, but I've already decided I'm not really interested in this. 2.5% original issue, debt issuance cost and discount for 24 million issuance costs. Senior revolving credit facility of 100 million, zero outstanding, collateral structure, first out obligations, covenants, asset coverage ratio. Net leverage must not exceed 2. Mandatory repayments, assets, they must prepay debt if sell anything over 20 million in assets. Interest burden, what this means financially. 150 million plus interest expense. The company's revenue EBITDA are falling, that's heavy. Yeah, because EBIT's 240, net income's 53. What have I done my interest coverage off of free cash flow in it? Yeah. I don't know if that's right, by the way, but that's what I've been doing off of. Why did the amendment? Falling oil prices, EBITDA compression, near-term maturity wall. To be honest, right, I don't think I like this. I think we're just going to move on. I think whatever I saw that I thought I liked is probably the book value, probably the tangible book value of it, and I just wanted to know what the whale was worth. It'd be nice if they broke down costs. P-Tau broke down all their costs. Extent exploratory costs. Maybe it was in here. Was it in here? P-Tau did it on a per barrel basis, which made it easy to say like, oh, there's God knows how many million barrels left in this, proved barrels left in this. How many barrels? Not that I think they're not in trouble, but it doesn't look good, does it? The outlook doesn't look good. How many barrels do they extract each year? I'm sure if I looked in this, I could find it. It will be in here somewhere. If it's not in this, it'll be in the 10K. 50,000 barrels equivalent per day. 18 million a year. What their costs. Problem is, I'm wasting my time now in doing this. $11 per barrel. $12 per barrel. I think, honestly, I'm just going to move on. Just one thing that I do want to check. I do want to check what the inside ownership is. The latest one. God, off what we done here. Control F. Beneficial. Should be a table here somewhere. Here we go, down here. So Hightower is 75%. John Paul DeJora Family Trust. 18. Interesting. Maybe that is the key. So how many proved barrels are there? Crude oil 135.3. So what did they say? What was $60? 50 with what, $13 in? So quick maths. Say it's $50 a share for $50 a barrel minus about 15, we'll say, for costs, leaves you $35 per barrel. What's the tax rate? 25-30%. 15 times point, let's just say 0.7. It's $10.5 per barrel after everything. Hang on a minute, what did I do? Lost my train of thought now. $50 minus 35. Minus 15 for costs, 35 times $24 per barrel, that is. What have I done it? Why did I come up with 15? Um, so proved undeveloped, proved developed, 108 million. It's about 2.6 billion of oil in the ground. The balance sheet HPK. Financial statement, balance sheet. Yeah, SM 3 billion worth, 4 billion improved, minus the depreciation. Minus long-term debt. Also liquidation value. You've almost certainly got downside protection with this. It's just, well, debt's going to affect. 0 messages remaining. See, this never used to happen. They have changed how it's used. I don't like it. 3.4 billion. 50-70% discount. Distressed buyer around about $1 billion. 1.2 billion. So they're saying there's no downside protection. Interesting. It's not as clear cut as what the PTAL one was, that's for sure. So I am going to pass on this. Spent 40 fucking minutes on it, though. I should have said no a lot faster than that. I am going to go and do a checklist on, does it meet this, does it meet this, does it meet this, can I say no to it as fast as I can, you know, because we don't want to be wasting our time. You know, it's never all wasted time, is it? Because you learn, but you know, we've wasted 40 fucking minutes there. Holding company which engages in acquisition of domestic middle market companies. That doesn't make any fucking sense. Las Vegas, Nevada, $4.99, $18 a share. I suppose really, if we were going to use tangible book value as a proxy for liquidation value, it isn't, but a proxy, then the fact that it's $18 and that is way above the tangible book value probably should be another reason I should just say no, move on from that one, you know? Yeah. Alright, I'm going to take a quick break a minute and then I will come back. You won't even notice it. Hour of video editing. But I'm going to have a quick break a minute and then we'll come back to it. Alright, we're back. I think I'm going to stop looking down through here on the screener for now. I'm going to try and finish up this video looking at Bumble because I had an alert. I set a price alert when it like broke lower, which it has obviously done. And I've looked at this before and I remember they got quite high inside ownership. I think the CEO owns a decent portion of this company. Pardon me. I reckon they're pretty damn good on free cash flows. And is there some decent, like I said, there's some decent inside ownership. I've already got it up here. Whitney Wolf, that's a woman in charge, CEO. She's sold quite a few bits lately, but 100% of her portfolio, she's got 120 million market value in this company, and it's basically 20% ownership of the company. Now that is obviously a CEO who's definitely got a vested interest in a vested interest in this company succeeding. Another one here, look, 14%. That's a large position. Was previously 22. There's been no change in shares, so obviously that must have come from the fact that the price has gone down. So it's ended up as a smaller position in their portfolio purely because of that. Nobody else really of any note though. Like these, I don't care for these down here. I'm not saying that, like 133 million is a small position, but look, in relation to their portfolio, it's not significant, like this at 14% of your portfolio, you've got to have some decent level of conviction in your trade there, and that's the sort of things that you want to look out for. That's what I've learned from like Roaring Kitty, Monish Pabrai and all that, and Warren Buffett. Well, they all say, don't they, that you want to have owners that have got skin in the game with you. So we'll look through the balance sheet, I think. No insider buys though, which is a shame. I do like to see insider buys. 4 years, about 4 years, and search again. Has there ever been a bloody advert? Right, hang on. There we go. One, a director who has lost a significant sum of money in 2022. That was a significant sum of money. Options that they've exercised and then sold. I mean, none of this is good looking, is it? Even when the CEO sells, but then that could be down to anything, can it? Like, you can sell for many reasons. Generally, you only buy for one. So got it up here. Ignore this. This is the HBK stuff. We're just going to look at the balance sheet for now. For Bumble, 300 million in cash, 90 million in receivables. Now, in a fire sale, how many of those receivables are you gonna collect? I don't know. I have read you can collect a high amount if you were to pay and wait for people to be able to recover it, but that's not generally, you're not generally given that time in a liquidation or anything like that. So I don't really know what we could go with, maybe 50%. So 360 million. There's no property in it, and effectively all your long-term assets are not really worth anything in a fire sale. You've got $1 billion in goodwill, over $1 billion in goodwill, 600 million in intangible assets. So the vast majority of your total assets are non-tangible. They're not worth anything in a fire sale. Now, like, I know that Bumble's a trade name. Most people have heard of Bumble worldwide. I would say most people, at least in the Western world, have heard of Bumble. Most people have probably even used it. But if Bumble went bust, would anybody buy the company name? Like Norton Motorcycles, for example, like they've gone bust several times. I don't think they exist currently, but people keep purchasing the trade name. Coca-Cola went bust, people would still be looking, I'm going to purchase the Coca-Cola name. So there's value to it, Whereas I just think if Bumble went bust, there wouldn't be anybody going, oh, let's buy the Bumble trade name. I think it would just be like, oh, I used to remember that company. So I don't know that you'd be able to ascribe any value to the trade name for Bumble, So the intangibles, nothing. Goodwill, always viewed as a future write-down. I think in the case of Bumble, it needs to be, because it has been written down several times. If you look at the earnings, impairment charges everywhere, almost $1 billion last year, $500 million this year. This is just in the 9 months as well, so you've not got the full thing in there. Their earnings are releasing on the 11th of March, so annoyingly, really probably looking at this at the wrong time because the data is almost as out of date as it could get. Page. But yeah, so realistically, you've only really got 360, 370 million in real tangible worth on the asset side of things. Don't get me wrong, like the current assets are really good. That's high quality current assets with all that cash. They've got 100 million extra cash than what you had last year. Right of use assets are not worth anything. Property, there's a lot of depreciation on that. Doesn't mean that's the thing as well, mind that net of accumulated depreciation now they're building in all likelihood is probably gone up in value, has to be depreciated, so it's probably more than that there. But realistically, you're still only looking at around 400 million max in tangible assets. Current portion of long-term debt is quite small, 5 million. Around 600 million in long-term debt. What's this? Payable to related parties pursuant to tax receivable agreement. So obviously you've got quite a big expenditure there. What does that mean? We'll have to have a look into that. So there's no downside protection. There's no downside protection from the assets. I think the tangible book value would tell you that as well. No downside protection from the assets. So any downside protection is going to have to come from the cash flows. So let's have a look. Net earnings negative, but then impairment losses 2 years running. That's where that's come from. I mean, that money has not been lost, has it? You haven't lost that money this year. It's just from GAAP accounting, it's had to be taken away, which is why it's added back into the cash flow statement. Quite high stock comp. I don't really like high stock comp. Is what it is, unfortunately, though. Receivables have gone up, so they're collecting slower. We can have a look at that in the working capital analysis portion of the spreadsheet. Paid payables, whereas last year they were holding on to them. Well, I think in the scheme of things, like the working capital side of it is reasonably irrelevant, because the capital expenditures are so low. Acquisition of intangible assets, they must have bought someone else last year. Look at the capital expenditures, 9 million. Because it's just an app, isn't it? You know, they've got to build in a few computers, programmers, I'm guessing. Finance and activities, even finance and activities is lower. So the entire cash position compared to the earnings, like there's a lot of cash being generated in this business. There's 100 million increase in cash, which you can see in the balance sheet. Look, 103 million increase in cash, and it's only trading for like $3. You need to look into the debt and see what this debt is, what the schedule on this debt is. I want to look into this as well, see what that is. It's in the spreadsheet. Revenues are down, but they're still around about $1 billion consistently for the last few years. Gross margin pretty stable, around 70%. Costs have come down 44%. SG&A margin down from 52%. R&D margins reasonably stable. But the 3-year average, this is 3-year averages, by the way, all of this. 3-year average simple free cash flow margin has gone up and up and up and up. Look. ratio is good. Interest coverage is very good. I like to see at least 3 times. It's $3, and there are almost $3 in cash. Obviously, you've got the debt as well. So if you take away the debt, it's minus $3, but almost 50% of the price is free cash flow. So it's like 2 times earnings against market cap. I don't do it against market cap. I do it against EV because you have to take into account the debt. Almost $1.80 in cash flow from operations. Net income's obviously negative because you've had those impairment charges. But trading at 2 times earnings to market cap. Like I said, I don't use market cap. I use enterprise value, but still 4 times enterprise value earnings. Like, let's just see what the debt is. I think, pardon me. I think one of the things with Bumble is it's done on like a valued on like a subscriber based thing, and they've had less and less subscribers. They keep having drops in subscribers, and then that obviously would directly affect advertising revenues and all that sort of thing. So I think maybe that's where the pressure is coming from, because it's throwing off free cash flow left, right, and center. You know, like, and the average, simple free cash flow average has gone up and up and up. 100 million extra cash than what you had last year, you know. It's very strange to me that it is so cheap. Let's have a look at what we can find on debt. Term loan there, so it's a term loan June 2027. Got a revolving credit facility. It doesn't seem too particular, like difficult this, but I will run it through ChatGPT and break it down like a retard again. What was I going to look at here? I was just thinking about something then. Yeah, I said about interest coverage, didn't I? That very good interest coverage ratio. Cost of debt doesn't appear to be too high as well. Yeah, TTM interest expense is like 45 million. It's nothing, is it? Like, they're able to service the debt, that's for sure. Just see if there's anything in here that's, oh, bugger off. Going on here? I want a new chat, not there's a sidebar. What's this? No. Just put it in ChatGPT and then it breaks it down for you. Both mature, so there's 700 million, is that what we're saying? 7-year loans with scheduled principal repayments. 50 million revolving credit facility matures in 2026. 450 million was available, so there's nothing drawn on that. 7% interest rate currently. 1% per year original principal, incremental term loan, same 1% revolver is not drawn. Company was in compliance with all financial covenants. I would think it would be with the amount of cash they're supposedly throwing off, you know. 850 in term loans. To reduce debt. With voluntary prepayments, which is good. What was the other thing that we wanted to look at? This one here. Break this down because it's just easier than, I know it's lazy. This is a significant liability, so I want to know what it is, and I know this is lazy. It's supposed to, but it's not. Doesn't make good viewing, does it? To read through all of this. It might not make good viewing. This might not make good viewing. I don't know, but when the company completed its tax, the organisation it signed a tax receivable agreement with certain pre-IPO owners. The company must pay those pre-IPO owners 85% of tax savings the company actually realises. Tax basis increases. Payments are not dependent on those owners continuing to own stock. Once the tax benefit is realised, the company must pay 85% of it. So, the company keeps 15%. Where does these tax benefits come from? At the time of the sponsor acquisition, assets and liabilities Bumble's holding was stepped up to fair value. This created additional tax basis. The company inherited that stepped up basis. I'm going to have to make it net operating losses. Why hasn't the company recorded all tax benefits? Pardon me. The company believes it will realise tax benefits from the common. What could increase the liability? It can realise. Big picture. The company owes 85% of certain. Why this? Right, hang on then. Explain it more simply from my simple mind. Why does this even exist? When a private company goes public, the IPO can create valuable tax deductions. The old owners want to keep most of that value. Instead of giving them cash up front, the company agrees to pay them later as tax savings are realised. For private equity like Blackstone, the founder own the company through a partnership structure. The tax deductions belong to them personally. They could use those deductions on their own tax returns. When the company went public, the public corporation became the owner of the operating business. The corporation inherited certain tax basis step-ups, more depreciation, amortization deductions. Those future tax savings are real cash value. Tax benefits were created because the old owners structured things that way before the IPO. They said those tax benefits came from us. We should get most of the value. The public company agrees. Fine, we'll keep 15% tax savings and pay you 85% as we realise them. Why not just pay them up front? The company tax savings happen over many years. The company doesn't know exactly how much it will actually use. Increase is what they get from the IPO. Public shareholders benefit from 100% tax. Why does a liability show? If the company expects to realise tax savings in the future, it must record as a liability equal to 85%. Okay. You sell me your house, but say if you refinance, get a tax break later, you owe me. Right, how long does this go on for? That's as long as the company is using tax deductions that were created in the IPO restructuring. When asset values are stepped, the company gets extra tax deductions each year. Most of these deductions are amortized over 15 years. Some assets are shorter ranges. They occur over 10 to 15 years, sometimes longer. So we've got quite a way to go because the company was floated when? Here somewhere. 21. Although it doesn't have the little dinosaur that it normally has. To show, oh, there it is there. Right. TRA ends when all step actions have been used, all net operating losses have been used or expired. So how does it work? How does it work in relation to any increase or decrease in earnings? TRA affects earnings in two different ways. Normal tax savings changes in the TRA liability. Normal year, company makes more money. Higher pre-tax income, step up deductions, reduce tax. This basis This basis step up creates amortization deductions that lowers taxable income, so the company pays less tax than it would otherwise would. Net income is higher than it would be without deduction. So far, so good. Because the company realised tax savings, it owes 85% of those to pre-IPO owners. So in a normal year, owners benefit from lower taxes. Cash flow is reduced by 85% because of the tax savings is paid away. This is quite complicated, isn't it? Whatever earnings decline, company may expect to use fewer tax deductions. How does this relate to free cash flow? Many investors treat TIR like a long-term payable similar to debt. They often exclude remeasurement gains. How it relates to earnings, lower taxes boost net income. Most of the cash savings is paid away. Right, what's this here? Company saves $100 in taxes this year due to step-up deductions. Company keeps the benefit. Company keeps $15.85. TRA liability by 85% times $270. Full income go. If the company gets a tax deduction, higher free cash flow with the TRA. When a company saves $100 in taxes, it keeps 15. Financing cash outflows. Okay, let's have a look. I am learning this in real time. Payments on tax receivable agreement, is that it? Gotta be. No. Most investors subtract TRA payments when calculating. Why it matters for valuation. Projected total tax savings equals 800 million. So is that going down year on year? No, it went up. Right, okay. What were we looking at? Payments on tax receivable agreement. Is it the payments on tax receivable? Got that wrong. Receivable agreement noted in the financing section of the cash flow statement. Yes, that is a line. So as a long-term liability, liability, there's is there a maturity date to have paid this? What is it? 400 and something million, isn't it? 419 million by, as it's the LT asset. So no maturity date. Most expected payments will occur beyond 12 months. When does it get paid? After tax returns are filed. Could it ever be due all at once? Yes, in some circumstances. Okay. We're going to have to look into that now, aren't we? Does Bumble a lump sum or any potential or accelerated given you the data already, haven't I? Based on the current projection, the company anticipates having sufficient taxable income to realise the benefit of this common basis and recorded here, by the way. Bumble can be required to make a lump sum payment under its tax receivable agreement, but only in certain situations. One, normal operation, no lump sum. Accelerating events, lump sum may be required. No fixed single maturity date. These acceleration events commonly include change of control, early term. If Bumble chooses to terminate TRA early with no lump sum, okay, breach or bankruptcy. What this means, under normal conditions, payment occur over many years. Upon certain events, lump sum. Why companies worry about a large accelerated payment could. Bumble does not own a single fixed payment due to the TRA liability, but the obligation can be accelerated under certain events. So you'd have to sell the company then, effectively. So if there is no plans to sell the company and it keeps functioning as a free cash flow machine, because it currently is, then there is little risk of this liability becoming a problem. Bumble continues to generate steady taxable income, and there is no change in the control of TRA's management, predictable, not existential risk. If the company remains independent, no sale, no breach, no payments happen gradually, they are funded out of tax savings, there's no sudden liquidity shock. Why it's less risky if free cash flow is strong, which we know that it is. I've got no messages left now. Look, they've definitely changed ChatGPT. If the company is a strong free cash flow generator, or low TRA payments because it's using deductions, but those payments are funded by tax savings. Cash is okay. So economically, higher profits, more tax savings, more tax savings. When does it become a problem? Change of control, liquidity stress. If the company is profitable for accounting purposes but has weak cash generation, which it doesn't, it has very good cash generation. Over-optimistic projections. Yes, if the company is stable and not being sold, there's very little risk. Okay. Clean way to think about it. If Bumble remains a long-term independent free cash flow positive company, TRA is manageable, it won't suddenly explode, acts like a slow cash outflow tied to profits, becomes dangerous mainly in mergers and acquisitions, distress scenarios, or aggressive early terminations. It's not a hidden bomb, it's more like a long-term royalty on savings. Okay. I feel a bit more comfortable about that now, because that is quite a significant amount. You know, it's effectively close to half of the total liability, so, you know, free cash flow is very good. The term loan due 2027, and they've got 300 million-ish, making 100 million a year. I mean, you could refinance a term loan, obviously. Possibly likely to do, but it's not a huge problem, is it, with the amount of cash that they've got? This is pissing me off. Why have they changed this? I've got another question I want to ask. Start a free plus trial to keep the conversation going. Assholes. Used to be able to drop down onto like ChatGPT 4. I don't know, like, any news on Bumble? News? Not really. Anything on Seeking Alpha? Old. That was literally 3 days ago. I see only one way out. 2 times cash flow, 3 times EBITDA. I said 4 times against EV, but core moats are eroding, with paying users falling, competitive pressures intensifying. Yeah, that's what I said. Like, cautious hold, potential M&A is the only credible upside. Yeah, but it's making like 100 million in cash flow, free cash flow. Last year, free cash flow, 150 million. 4 times earnings. In 4 years, that company would have paid for itself. There's a stock that's fallen 66% in 1 year. It's been falling more than 96% since its IPO. So when is it going to get cheap enough, you know? Its valuation has been greatly compressed and now the company's trading a virtually bankrupt business. It's impressive with multiples such as 2 times cash flow and 3 times EBITDA, which means that the entire business would pay for itself as long as the financials hold up for a few years. That's what I just said. Thinking the same way. But still, fundamentally, it does not seem like a buy to me. The moats are deteriorating, the trends are not favourable, and the financials follow suit. So my prospects for this company are very poor. But since valuation is extremely low, I think there is a way out, some M&A event. Then they got to pay off all that fucking 400 million. Bumble's business associated relies heavily on moats such as network effects, although it's not such an meta. Bumble's case is quite different as its apps are not that social with very narrow focus on dating. This already opens up some room to say that the network effect here is not that high. There's not as much loyalty as there is. No, that's true, because people jump between Bumble and Tinder and God knows what else there's still out, like what else is out there now. Average revenue per paying user still gone up. Paying users, this is the problem here, like 18% down. Maybe people just don't want love anymore, you know? Badoo. They own Badoo as well, do they? It wouldn't even be worth going too far into the financials because Bumble's company is unable to sustain its main KPI. Several factors drive this. Hype surrounding these apps has passed. It's not a secular trend as expected in competition. Still think like well, clearly the data here shows different, but less and less people are using them. But I haven't been in the dating game for a long time, so I won't know. I don't know. Like, just seems like people probably would still use dating apps in this day and age. Not many kids seem to go out anymore, do they? Beyond external reasons, there were some mistakes in timing and vision in my Bumble acquired an app aimed at Gen Z a few years ago. This was recognised as an impairment loss of 400 million. Yeah, it was too expensive and acquisition did not bear the fruit the company had hoped for. So here we go. Right, net income was 51 million, so after removing depreciation and impairments, adjusted EBITDA margin of 30% at good views. Cash flow also follows these numbers. In Q3, the company managed to generate 76 million in operating activities. Why I don't think it's a sell. There are a few reasons why I don't think Bumble is a sell. The first is valuation asymmetry. It could be a cigar, but yeah. Note that even with the market, so what's he expecting it to just disappear? Even though it's making 150 million a year. I don't have confidence in Bumble's business. Valuation is asymmetric. If anything positive happens, it could trigger a re-rating, and if it starts trading at 1 times forward sales, we've already talking about an upside of more than 100%. Yes. That's not my base case scenario, but asymmetry comes from the worst that can happen is the company goes bankrupt, going to zero, but something goes right, it can unlock a lot of upside. It's going to be hard to go bankrupt when you're making 100 million a year in free cash, though. I don't think it's an obvious scenario. almost 3.6 million paying users alone, which means that free users, total user reach similar to Instagram, really? At that time when Instagram got bought by Meta, he's talking about. No, they wouldn't want to buy Bumble because Instagram is a way different app. It's not yet a company doomed to bankruptcy. Its balance sheet is positive and its financials are still at healthy levels, but operations are not good. Interesting. It's interesting because he thinks it's potentially it's a goner. Comments, anyone says that? What a passive investment that could change the presence. They filed a 13D, these. Oh, Sapper. What is theirs? Just a 13F. Okay. Oh, over here. Hmm. Technicals look bad, no support, probably going lower. Yeah, I agree with that. We can just. It's never been this low before, and it's just broke through a base. I mean, if this is a channel, which it appears to be, technically, it is at least going down to like $2. This is a tricky one, isn't it? Like, I've been interested to see other people's opinions on this if they watch it this far. Definitely more compelling. I never viewed this as a growth industry with big players of a playbook. So I'm reading this in my head and forgetting that I'm meant to be talking. Bumble needs a strategic pivot a la Netflix and needs to move into content creation models and Bumble TV. But doing some form of sugar baby pay for play only fans model, really? That'll ruin it as a dating app then, wouldn't it? Would it not? People thought it was an OnlyFans type thing, no one would want to use it. Wouldn't be very classy anymore, would it? Yeah. It's a tough one, isn't it? This is a tough one. Sale last year's user defection steepens. This guy who said it was a buy in November last year. Not gonna read through it all, see if anyone says anything. Blackstone may take it private, still no position, even cheaper now. 300 shares. Haven't followed the stock, but wow, it crashed. Market punished weaker balance sheet, plus the fact the IPO price was way too high. You can gather that. Look at this. IPO'd it, what? 70 something. Given the no-nonsense founder coming back, a strong emphasis on product that drive revenue, only disagreement is the expectation of stock price. My thesis is at $9 we reached a lot faster than 2028. It's interesting, isn't it? Like, these people are saying it's cheap. The last bloke said it could go bankrupt. I feel like bankrupt's tough. I feel like it's tough. Like, simple free cash flow, 150 million, 145 million, 150 million, 86 million. Like, you gotta be doing something stupid to go bankrupt with throwing off that much cash, you know? This is a tough one. I would like to know anyone else's opinion on this if anybody watches this far. I can't say it's execute perfectly, but it's continued to generate healthy cash flow, manage some of its costs, and improve its balance sheet over the last 2 years with a lower stock price as well. Oh, man. this was a tough one for me last time I looked at it, and it's still so now. Anyone else's opinion on this, please? It would help massively. I don't know what to make of it. The cash flows are screaming that it looks cheap. The stock price is doing everything but that. Share skyrocket. Oh, hang on. 4.9% is now signed by Bumble. Or analysis report here. I ain't doing that. It jumped 5.5%. Why would the tariffs? Oh yeah, it has up over $3. Look. I mean, still, technically, you're probably coming down here. At best, it's going up to here. Technically here, look, price bounce. So there's money in this area. There's a lot of money changing hands in this area as well, but then the sellers won. I think long term is probably still coming down to 2. But if right, technical analysis here, so voodoo, but if it goes from top to bottom, you've got a potential 200% upside if it reaches the bottom. What I'm going to do, put another alert down here, and we will see if it triggers. If it does, I don't know, maybe. Tough one. Anyone has any opinion on this one, I'd be interested to hear, because buying 150 million in free cash, 600 million, yeah. Revenues are, they have like fallen quite badly, to be fair. 40% free cash flow margin. What are we going to say then? Let's do some quickly. Let's do some quick conservative estimate of future revenues. Let's say it went down to 850 million. 850 million. 20% simple free cash flow. What's this one? It's not 7 years. It hasn't been 7 years. Which one's I using then? C2. One. Let's just go down to the Greenblatt one. Future simple free cash flow multiple 6. So it's more, it's less value in the future effectively than now, because this was at 4 times currently and 2 times currently. The market cap to EV, essentially 100 million in free cash flow. My Monish per buy calculator, which is using discounted cash flow for X number of years, and in the X year you sell the business for a multiple and you add that to the price, and this is saying 6, 7. I sound like a right twat then, didn't I? Because the kids keep saying that. It fucking annoys me. But it's $3 in future free cash flow over the next 5 years. That pays for the company. This one here is like a Roaring Kitty type thing that he did for his GameStop, longer to GameStop video, where he did the percentage of the future free cash flows added on to a value of like an asset value. Obviously tangible book, I use tangible book value because goodwill and all that's not worth anything, is it? Especially if it's being written down all the time. But if you add the free cash flow to that, because the amount of goodwill and intangibles is still a negative, which obviously would be a bankruptcy. $1 Joel Greenblatts. So that would be 3 times earnings. It's currently, that's market cap. Honestly, I am head scratcher on this one. And to be fair, right, if you're a head scratcher, that should be a no, shouldn't it? Like Monish Bryce said, it's got to bang you over the head as looking cheap, and just with the way this company is going and subscribers and all that. Yeah. I don't know. I'm going to leave this one here. If you've got an opinion on that, please chime in. It's quite a long video, actually, this one. But Bumble's interesting one for me. It was interesting when I looked at it. Initially, I didn't know what to make of it, so I put an alert for it to go lower. It's obviously triggered that alert and it's still going lower. So, we'll see. It could be one of these that consistently looks cheap, consistently stays profitable, and then still ends up disappearing. You know? Anyway, that's going to be the end of this video. I'm going to leave it there. If you've made it this far, please like and subscribe. Thank you very much, and I will see you on the next one.